And it gets a little bit more tricky on the last 2 points in here, and this is basically Clickthrough Nexus, and I'm not sure exactly how familiar you guys are with Clickthrough Nexus, but sales made via commission independent contractor who refers potential client by a link on the internet website. That also creates Nexus. And Clickthrough Nexus is not in every state, but most of the states, it's a growing trend. Really, we had, I believe, 3 or 4 new states that actually implemented the Click-Through Nexus this year alone. So it seems that at some point that everyone will implement some type of form of Click-Through Nexus. So what is sales tax imposed upon? And this is just some keynotes, just general overview for everyone just to keep in mind. It's always imposed on tangible personal property. So if you are in a state where sales tax is imposed, then just keep in mind that all tangible personal property are subject to sales tax. There's obviously exclusions and exemptions to the general rule. Food is one of those, medicine. There are various exemptions for manufacturing and research development companies, sales to government entity, and sales for resale. Just bear in mind that once you have a specific exemption in the state, they have to be supported by an Exemption Certificate form, which we'll talk at this other slides coming up. So for example, when we have a sale for resale, the state says, I want to get my fair share only once during the transaction. So if you are selling a product or tangible personal property to another company who will resell it to the end consumer, the state only needs to get the sales tax once. So therefore, that first transaction is not subject to sales tax. It's exempt. However, there is a form that needs to be received in order to support the exemption, which is called the resale exemption. And we'll talk more about that at the later slides. Also, going back to what sales tax is imposed upon, so if we take the state of New Jersey, for example, it's imposed upon tangible personal property and certain enumerated taxable services. So states will enumerate the taxable services for you. And this is, again, just general what I have on the slides. It doesn't pertain necessarily to one specific state. But generally, fabricating, producing, processing, and printing are listed as enumerated taxable services. Repair and installation, information services, security services, landscape services, and temporary help. Temporary help services is more, it pertains to the state of Pennsylvania. They're generally taxable there, but not necessarily in New Jersey. But just keep in mind that every state differs on what they consider taxable service or not. For example, California, the taxable services are very limited. They have a broad exemption for services in California. Okay, so what is use tax? So this is one of the questions that I get a lot. Use tax is the same thing as sales tax. However, it changes in regards to how do you collect it and such. So for example, if I purchase online from company A and sales tax was not charged on my purchase of, let's just say, a laptop, which we all know is subject to sales tax because it's tangible personal property, then what the state of New Jersey says that I have to pay use tax on this laptop because the use of this tangible personal property in the state of New Jersey is taxable. So it does not matter that the seller did not collect the sales tax. You still have an obligation to accrue and pay the use tax. As an individual, you're supposed to do so and pay it with your 1040 whenever you do your personal income tax returns. As a taxpayer, you are supposed to do it with your sales tax return. So let's just say that you're a quarterly filer, then you would remit the use tax quarterly also. And you will say, well, lady, well, how come this particular vendor did not charge me sales tax? Why do I have to go out of my way now and have to accrue and do an extra step that I don't want to do? One of the reasons are because they're not a state vendor. They have no nexus in New Jersey, let's say. So therefore, they cannot, or they don't want to, collect sales tax in New Jersey. And another reason is because vendors don't have accurate billing systems in place. So I get this all the time where they say, well, company A, they should know what they're doing, so they didn't charge me sales tax. I'm okay with that. No, it doesn't necessarily mean that they know what they're doing. It just means that something went wrong. If something is taxable, then you should accrue the use tax. Promotional giveaways are the most interesting one because this is not a lot of taxpayers are aware of the use tax that is due on promotional giveaways. So let's just say that you would like to give out promotional items, or you do give out promotional items on your trainings or and things like that to promote your products. A lot of my taxpayers say, well, lady, I don't have to, there's no sales tax, there's no price, I give it away, it's a gift. Well, no, that's not necessarily the case. Use tax is due on those products, okay? So, and they're usually based on the cost price. There may be no sales tax that you could collect from your customers. However, you have to accrue and remit the use tax. The same rules that apply for sales tax purposes apply to use tax. And like I said, it's remitted with the sales tax return. Exempt sales and purchases. So this is going back to a couple slides ago. You have to retain the proper documentation in order for you to claim exemption. Resale certificates are needed, especially for sale for resale. Exemption certificates if you are an exempt entity. Direct pay permits. So this is quite interesting. Direct pay permits, and not a lot of people are aware of those, but basically a lot of states allow for big taxpayers that have a voluminous amount of purchase transactions to register or to enter into an agreement with the state where they don't pay any sales tax. However, they accrue and remit the use tax on the items that they deem to be taxable. And there's obviously procedures that they take in place, and obviously it's listed in the agreement between that they have between them and the state. But just be aware that there's this other form that is called direct pay permit. What to take from this form that I've listed in here is that they have to be properly completed in order for them to be valid under audit. So let's make sure that they have all the information, the purchaser, seller information, signature, date, reason for the exemption and such. And then also keep in mind that some of these forms are state issued and some are actually just a blank form that is completed out. For the ones that are state issued are always will always be the direct pay permit. And the exemption certificates, in some states, the state will approve your exempt status and give you an exemption certificate.
Can I ask a question?
We can. Go ahead.
Just a quick question. From a supplier or vendor perspective,
yeah.
Can we receive a direct pay permit in place of a resale tax exemption?
Yes, you definitely can. But the things to make sure, there is probably, I would say, a handful of direct pay permits in every state. Maybe not a handful, but 20 or 30. I would confirm it. There's always on the state's website the list of the direct pay permit holders. It has to be an account there also. I would just look and make sure that's the case too. Exactly. Just a couple of things to be aware of. Drop shipment scenarios, those are always complicated. Overuse of exemption certificates. You don't want to be in a scenario where you just keep giving certificates out and no one charges you sales tax where they should have. So be careful on where or who you give this exemption certificates to. And obviously incomplete, invalid certificates. You want to make sure that they're all valid, because let's just say that they go out of business and here you're under audit and the auditor will refuse to accept the certificate because it's not completed correctly. So here you're stuck with the liability. Sales tax audit. I think this is the one area that everybody's interested to hear about. The question that I always get is, why was I selected for an audit? So I've listed a couple of examples in here. Frequent late filings and payments or no filings and payments. So let's just say that you have been filing regularly and then all of a sudden for a year now you keep either filing very late or missing periods. So that triggers an inconsistency. It shows the state that you're being inconsistent, so therefore you may not know what you're doing. Nexus with no registration. So as states are getting very hungry for revenue, what they're doing now, they're looking at companies that are not registered in a particular state. and they want them to be registered in a particular state. So if you have nexus in a particular state, let's just say you have payroll, but you decide not to register, then it's going to trigger an audit for you. Resale certificates with no sales tax registration. Let's just say that you've been issuing resale certificates out. However, you didn't put a sales tax registration in there because you're not registered in the state. And under audit, they reviewed the certificate. So the state is saying, well, let me look to see what's going on with this one particular taxpayer. And then they come and audit you. Trickle down from audits of vendors. So this is an interesting one. You get discovered by the state auditing your customers. Internal whistleblowers. Let's just say you really upset someone that is working for you. They may call the state and they may let them know that you have nexus and not filing, or you should be audited. No reporting of use tax. High sales volume. So obviously auditors look at this too before they send an audit notice to see, okay, is it really worthy for them to spend the time auditing you? So obviously if you do have a high sales volume, they will come and audit. Large amount of exam sales. So let's just say that you have $10 million in sales, however you claim an exemption for 90% of those. The state may wonder, especially if your business is something in the nature where you may not have exam sales, they may wonder whether you know what you're doing, so they want to come back and audit. I wanted to also list some of the very important things to do as part of a sales tax audit, just to kind of prepare. And as you go through an audit, just to keep in mind what are some of the things that you need to deal with. Planning is very important. Information requests, and we'll discuss this on the other slides. What information to give to the auditors. Let's not voluntarily give them everything. Let's see what they really, really need to see rather than just divulging information to them. Sample selection, this is also very important. Relationship with the auditors, and also I've included some do's and don'ts of an audit. So the first step will be to decide and designate who will be managing the audit. I think it will be much easier and much organized if it's decided that one particular person or even two will be handling the audit or managing the audit. It's very unorganized and scattered if you have 3 or 4 different people. The auditor may feel overwhelmed. They may not be getting he or she may not be getting the right information. So you always want to make sure that you have a plan ahead, and then you decide who will be the designated person that will always be in the contact with the auditor. Negotiate key issues with the auditors prior to starting the audit. Obviously, you want to discuss about some of the open issues that you may have during the audit and negotiate them, whether it is some of the invoices got lost during the audit period, whether it is whatever the case is. You may want to bring this up in the beginning so both of you can come into an agreement going forward. Develop an agreement that sets out a roadmap for the audit. Discuss prior audit with the auditor. Discuss and select accounts of interest. Mutually agree on sampling methods. Discuss how missing information, if any, will be handled. So it's very important, especially I would say for the sample agreements, that both the state or the auditor and the taxpayer come into an agreement with what the best periods will be that will be represented during the audit. So when you look at the audit, you have the sales side, and then you have the expenses side and the fixed assets. Fixed assets are always reviewed in detail, so you wouldn't have to worry much about fixed assets, but expenses and sales are usually sampled out. So make sure that you come into an agreement on a period that is representative of the audit. Information requested by the auditor versus what should be provided. So I have clients that when they first meet with the auditor, they'll give them everything. Meaning, if you have a New Jersey audit, they'll give them Pennsylvania information, or Texas information, or everything they could think of. Usually the auditor comes in with one of his request lists, which is about, depending on the state, but it could be from 1 page to, I don't know, 2 or 3 pages. But just keep in mind that you don't necessarily have to divulge all this information out to them. But what they do really need are sales invoices, sales journals, resale exemption certificates, purchase invoices, canceled checks, purchase orders, shipping documents, working papers used in the returns. And this is just a few examples. Depending on the state, then you may have to give them some additional stuff, but this is a good start. Sampling general guidelines, this is very important because I've also noticed that with some of my clients, they generally don't pay as much importance into the sampling selection. Being that the sample represents your whole audit period, whether it's 3 or 4 years, you want to make sure that you know or you come into agreement with what you are providing. So definitely you should know the data. I've actually had clients that just handed over the data to the auditor without even knowing what it meant or what it was, and just said, well, I'll just let the auditor figure it out. No, not really, because the auditor, if they figure it out, it's not going to be to your benefit, it's going to be to the state's benefit. Should only include GL codes that have indirect tax attributes in the audit population. So let's not include things that are not relative to sales tax in the review. Should never provide invoice data at kickoff meetings. I've actually had this also, where we go into a kickoff meeting and the client comes in with everything that you can think of. Let's not do that, right? Because we want to make sure that we want to look at the sample. We want to make sure that we agree on the sample. So let's not divulge information first before we were asked. Should not sign or agree to jurisdiction sampling agreement immediately without further review. Should always review the auditor's calculation. Exactly. So this is one of my most important key points that you should guys take is the review of the auditor's calculation. I would say 9 out of 10, there's always going to be errors. Should always discuss procedures concerning currently not available for review invoices before beginning the audit. And I just touched on this on the previous slide. Before I had a client once where they lost their invoices during the flood. So they had lost all invoices for, I believe it was for 2 years or something. So we had to discuss this ahead of time. How would we look at what sample period would we take? What invoices are left? How should we project it? So that conversation should be done in the beginning of the audit. Sample selection. Definitely you should know the jurisdiction's audit sampling guidelines, statutes, and regs. You should choose a proper sampling frame. So there are different various of sample selection that you can do, whether it's by time period. So you may want to say, okay, I just want to give you the first quarter of 2015 as my sample. You can do it by range of accounts or cost or business unit. Or system changes. So be aware. So for example, let's just say that you had personal changes and you're trying to select a sample. You want to select a sample when you did not have personal changes because they may have changed or differed into, okay, was use tax accrued or not, was sales tax paid on certain invoices. So you want to make sure that you select a period where there's really no, it's representative and there's no different or odd things happening. Or, for example, a business change is one of those things too. Extrapolating results to the other periods. So one question is, can the results be extrapolated? Let's just say that you reviewed or the auditor has reviewed 1 quarter of the sales data. And he says, well, lady, I would like to extrapolate this in the past 4 years. And I would say, well, okay, I agree with that. But one of these items in the sample, it seems to be a very high dollar amount. So I don't agree that it be extrapolated. I think it should be detailed because it doesn't seem as the norm or the regular amount on this sample. It seems to be a lot higher, which therefore should be detailed. It's not represented here. And then the auditor, usually they do agree. They're very reasonable. However, you do have to bring these up to their attention because they will not bring this up to you. Discuss credits and refunds. So during an audit, obviously, it's a good time to look into to see if you have any refunds. So you may want to have the discussions or how will the refunds be applied to the sample selection. Block samples are, so New Jersey has block samples and a couple other states, and in this slide I'll just go in a little bit detail what block sampling is, and this it takes you back to statistics class. Block sampling is by selection, whether it's by time period, by vendor, by store. So the auditor comes in and say, I would just like to review all these vendors that I've listed here in the schedule, or I would like to review all transactions for the first quarter of 2015, whatever the case is. There are some disadvantages and advantages to block sampling. One advantage is that it requires limited knowledge, the statistical sampling method, which for some people can be pretty intimidating. And also recent months can be selected if missing documentation is an issue. A lot of my clients will say, lady, I don't care about doing statistical sampling. I'd rather just have them come and look at the recent quarter because I have those invoices, I have those information. Prior to that, I don't have. I don't necessarily agree with them all the time. I say we should find them because, you know, who's to say that this last quarter is the most representative one, but that's another conversation. Block sampling disadvantages. There is no mathematical basis for measuring sampling risk, no information on periods or store days not sampled. So, you know, your business might be booming in the first quarter of 2015, and you are auditing that period, but however, before that, your business wasn't booming, but now you have a high ratio that you're going to have to apply to the whole audit period. So it's good to look into the sample selection. Statistical sample, which is my favorite one to use if the state allows it on the audits. Statistical sampling methods, the population is divided into groups called strata. Transactions have similar properties within each group, but properties differ across groups. A simple random sample is taken from each strata. Advantages is very efficient. So you have an audit with, let's just say it has 4 different strata, then you would only look at 600 invoices or transactions. As of if you select a quarter, first quarter of 2015, you may have to look at 10,000 invoices or transactions. It produces measures of sampling risk, so it gives you an idea what the risk is. Disadvantages, it requires knowledge of statistics and sampling methods. It can also be complicated. Here are some sample audits gone badly. When the population is not reconciled before you hand over the sample or you agree to a sampling method and you give out the AP file to the auditor, the taxpayer had 3 months of sales data missing and another 3 months of sales data duplicated. Problem not recognized until auditing of records was well underway. So without understanding your data and reconciling your data, you're not really sure what you're giving your auditor, and you may give the auditor extra information. And then when at the end the sales tax due is calculated, then you're really paying more than you should have. Taxpayer used Excel to extract monthly purchase data, and the data overlapped. Again, there was no reconciliation done. There was no due diligence done on the population review. Auditor repeatedly requested data for a sales and use tax audit, but taxpayer couldn't provide usable electronic data. I have a lot of clients that say, well, I don't have it electronically. The files, here is PDFs. I had a client give me 1,000 pages of PDF to give it to the auditor. I said, okay, I'm going to have to look through it first because I'm pretty sure the auditor is going to totally miss the amounts or report or enter the wrong amounts, which sure it happens. Data provided did not reconcile to financial statements. Taxpayer claimed IT department couldn't provide complete data because the firm was acquired during an audit period. Auditor, and this is a key here, auditor issued a preliminary assessment, included the non-reconciled differences of taxable sales. I've had this happen more than not. So be very careful. The auditor's job is not to figure out your data, and whatever they don't understand, they will assess the sales tax on. Specific audit sampling issues arising in sales and use tax audits. Population-based dollar amounts summed incorrectly, resulting in error in project tax. So always review auditors' schedules because, like I said, 9 out of 10 there's always some inaccuracies. Assessments scheduled in a wrong exam. I've seen this also, where one item that was purchased should have been a fixed asset and detail was entered to expenses and it was projected against 4 years, which therefore it became a higher dollar amount liability. Interest computed incorrectly, and this is a little bit difficult to see from a taxpayer perspective of view because they usually get the interest calculation by the state, and sometimes they're not really sure what it is, but what the state will give you is an interest that it's calculated based on each year. So look at those schedules and make sure that it makes sense to you. This is a very important one. I've actually had clients who will put auditors in basements under horrible conditions. Treat your auditors with professional respect. For me, I found it very helpful. You kill more bees with honey, so just be really nice. I think niceness goes a long way. You treat the auditors with respect, they will treat with respect, and believe it or not, they will be very lenient if you do create that great relationship with them. Develop a report with the auditor in order to engender mutual respect and trust. Provide a quiet workspace for auditor. Respond promptly to reasonable requests from the auditor. I have clients who totally disregard auditors' emails, and then until they get this threatening email from the auditor saying that the auditor is going to assess based on what they have, which is never good. Assign contact person, which we spoke about that. Never let interaction, discussion, negotiation with the auditor become personal. This is very important. You know, you have to keep in mind auditors are doing their job, so therefore they're there to do their job. It's never a personal thing, so let the emotions not be part of that. General duties of a sales tax audit. Take a proactive role in managing the audit. Be prepared for initial meeting. Stay on top of audit throughout its lifetime. Close the audit with notes for preparing for the next audit. Know your data well prior to audit. Your IT should be your best friend. Make sure that you're close to your IT and you understand what information is given to you. And also, IT will be a good friend because they will be able to develop certain reports for you. I worked in the industry before, and I have to say the first conversations with IT are always hard to have because they say, well, it's there, it's not possible. However, if you show them step by step what you're looking for and why you're looking for those particular things, that will help you. Be prepared to discuss data and sampling issues. Know the jurisdiction's audit sampling guidelines, statutes, and regs. This is very important. Sales tax, it varies. It varies in every state. So how New Jersey treats certain exemptions, Texas is not the same. California is not the same. So you can't approach it expecting the same results. General don'ts of an audit. Do not allow the auditor to have unrestricted access to your facility. Do not allow the auditor to access any individual other than the designated contact person. And I have this happen more than not. I would say 40% of the time the auditors just kind of roam around and go ask the AP lady and then somebody else and the AR lady, and I say, listen, I'm the only person that I'm allowed to speak with you in regards to the audit. You and I will be the only people discussing the audit, and they will not like for you to go ask other people because that's just not how we're going to do this audit. So also advise your internal people to not have or divulge information. I've had this happen too, where the AP manager decided to offer the whole a lot of information that really the auditor did not need to know. Do not take a reactive position with the management of the audit. Don't just sit back and say, oh, okay, I'll figure it out, and then you have 3 years into an audit. Obviously, the penalties now at this point and interest are going to be a lot higher because you've just been sitting on it for so long. And that was just basically just some overview of an audit. Sales tax compliance, I believe I only have just a slide or two. Just a few things that you need to be aware of. Proper software system in place to capture the correct sales tax. It's very, very important that you have the system in place to do so, especially if you do business in states where they have local jurisdictions and you have local filings also. Another key important part is accurate sales data report. I have clients that use 6 different reports that come up with one, incorrect reports. So it's really important that you do have a accurate sales data report, excuse me. Do a periodic reconciliation of sales tax collected versus what was remitted. This will give you a general idea of how you're doing and how the reports are working, because I've seen instances where sales tax that was collected was much higher than what was remitted. So that means that the report that you're using is missing some of the transactions that should be reported. And obviously, sales tax that is collected needs to be remitted to the state. You can't hold that you can't hold those funds. And do a periodic review and update of resales exemption certificates. Late filings and frequent amended returns can trigger audits. So that's why sales tax compliance or proper compliance is important. Nexus and taxability review. So I have a lot of clients that come to me and say, well, lady, it seems like I have Nexus. Now I need to register in every state. Well, not necessarily. So Nexus is the first step that we look to see whether you have to register or not. The second step would be, let's look to see if your products are taxable in a state or not, because you may be in the instance where your products are exempt there. So depending on the state, you may not have to file returns at all. You may not have to be registered. And also, you may have, let's just say that you have Nexus in the state of Utah, but you have very small sales in that particular state. So you may decide not to register there because the cost of compliance oversees the liability that you may have in the state of Utah. So it's important that you do a taxability review of your products. And then obviously, you know, an outside provider, or it can be done internally, can provide you with a taxability matrix and a taxability memo for the files. Questions? I know I just went really fast, I think.
If anyone on the line does have a question, you can feel free to type it into that chat or questions function, and we'll pose it right now. And if you want to see if anyone in the room has any questions, they can feel free to ask as well.
Nothing in the room, Justin.
Okay. All right, we do have a couple questions here. The first one is, what would you say are the 1 to 2 biggest takeaways of this presentation?
Good question. So obviously be aware of Nexus. And I would say the second point would be audits and the way that you would manage audits.
Okay, great. Let me see what else. All right, the next question we have is, if you could give one piece of advice when going through an audit, what would it be?
Know your data. I think that would be my number one. Know your information, your data that you have, and then and I will add another one, and this is just from my personal experience. Be very nice to the auditor and create a trusting relationship with the auditors. I've had auditors who have decreased the liability in half or more because we had that trusting relationship, and we didn't have to look for additional information. They trusted what I said. It's very important to create that good relationship with the auditor.
All right, the next question we have is, if you are audited and you don't have all of the exemption certificates, what recourse do you have?
You can go get them, right? So depending on the state, some states you have to have the exemption certificate 60 to 90 days after the sale. However, some states will allow you under audit. So as soon as you get audited, what I would do is I would actually go request it and maybe ask them to sign and date the certificate based on the invoice date, and they could probably do that too.
All right, great. I'll leave this open for another minute or two in case anyone does have any more questions.
We have one question.
You want to let? Go ahead, Ken.
We have one question in the room.
Yeah, just real quick, going back to the resale tax exemption certificates again. I know that each state has different time periods for the certificates. Is there a minimum number I should use across the board, or any suggestions?
Yeah, so I would say they should be renewed if we're talking about renewal every 3 to 4 years. But then you have the one-off like Florida where the certificate, resale certificate is only good for a year. But the general rule, I would say 3 to 4. But there's always going to be some variances there where Florida, like I said, but it says on top of the form that it's only good for a year. California is good for a limited amount of years. So I've seen certificates from 1960. But I would say every 3 to 4 years.
How long do they give you to pay the assessment if they assess you for taxes due? Do you have 6 months, 3 months?
You definitely don't have 6 months. So what will happen is you come into an agreement with the audit results, and the auditor will say, let's just say in New Jersey, and that's when are they going to be able to pay it? And I say, well, can you make the payment due until 2 weeks from now or 3 weeks from now? Because they will run the interest and to show that 3 weeks from now that they will get the payments, because the interest is going daily. So what happened is some taxpayers will pay it by then, some will not, and then they'll go back and they will pay that plus additional interest that has accrued until the day they pay it. But I would say maybe 2 weeks, maybe a month, but you can do payment plans if you wanted to. However, when you do a payment plan in most states, they will put a lien on your property. So I don't know, a lot of taxpayers, if they have location in the state, they don't like that. But some of my taxpayers, if they don't have a location, they say, well, I don't have a property in the state, so there's, I don't mind. But yeah, so there's options. So there's options. Definitely, they do have a payment plan.
All right, great. It looks like we don't have any more questions coming in, so I think with that, we'll, we might have one more.
Is there a statute of limitations on how far they can go back?
The audit?
Yeah.
Yeah.
Can they go back
Yeah.
20 years?
No, but if you were not registered in the state, they'll go back as far as they want to. If you were registered, you stop that look-back period. So New Jersey 4 years, Pennsylvania 3 years. So, but if you were never registered in the years, I've seen in New York, my clients, the auditor came in and audited 9 years. So.
Just so that everyone knows as well, we are going to be sending a copy of the presentation to everyone who's on the line today. So you will be able to look through it, and then you can reach out directly if you do have any questions. All right, another question we have here is, should we be requesting an exemption certificate based on the state we ship to or the state we invoice?
Ship to. Always ship to.
Okay. This is a little bit of a more specific question, but the question is, do you know if New Jersey or New York's tax exemption certificates have an expiration date?
Yes, they do. Now, it depends because New York has a lot of different exemption certificates. So depending on whether it's an exemption certificate because a not-for-profit hospital, I'm not exactly sure. But yes, there is an expiration date, I would say, in both states.
Okay. All right, yeah. Wait, one more coming in. The question is, why would you request a resale certificate for where you ship versus where you are billing?
Sales tax is a destinations tax, which means that it all depends on where you ship it and where it's being used. So therefore, the billing information has no bearing on how it's imposed or where it should be imposed. So it will always be based on destination. So If I ship goods to Florida, I collect Florida tax because it will be used in Florida. It's all based on where it will be used, and that's why the shipping address is used.
All right. We also have a question. Do you happen to have a good website to research the expiration dates that vary per state?
No, unfortunately, there isn't one. It has to be specific to each state. But I would say, as a rule of thumb, you know, when you look at the exemption certificates, it says in there if it's a state-issued exemption certificate, if it's a form, I think, like for example, Pennsylvania, it's a blank form where you fill it up, or Texas, I would just make the rule of thumb that it's renewed every 3 years. So it's only good for 3 years.
Okay. Another question is, what if an exemption certificate appears to be completed but the registration number is incorrect? Who is liable?
Good question. So it all depends on what state we're talking about, but there is this argument of accepted it in good faith, which you can use, that you're not liable because you say that I accepted the certificate in good faith. As far as I knew, it had all the required components on it. Therefore, I should not be held responsible for it. Now, every state has different requirements of what they consider good faith acceptance. I'm not sure if the number on the certificate, if it's incorrect, it would be a burden on the seller. But generally, the good faith acceptance should cover it. However, it's very important to know that the rest of the certificate has to be fully completed. In order for you to say that you accepted in good faith, and when you received it, you really didn't know for sure whether it was for the right reasons or the number is correct, but it seemed to be properly completed, you want to make sure that it actually is, meaning it has a signature, it has a date, it has all that information that it requires you to have. If it doesn't have, then you will not be able to make the acceptance in good faith argument, and then therefore you probably will become responsible for the incorrect use of the number. However, I have to tell you that depending on the relationship that you have with the auditor, they may accept it even though it has the incorrect number in it. They may say, go back and get the one with the correct number, or they may say, oh, I see, they issued you the wrong form, or whatever the case is. But that's why it's important that you do have the relationship with the auditor. So transactions and things like this, he or she may just overlook it.
Would you be given an opportunity to, if it was like a typo, to...
Yeah, go back. Yeah. Yeah. If it's a typo. But you may have instances where that taxpayer, well, your the vendor, right, they're not registered, and they just send you a form. Let's just say they sent you a Pennsylvania form with the New Jersey sales tax license number in there, and they're not even registered in Pennsylvania, but Pennsylvania requires you to be registered there. So you present an order with the certificate, it means nothing to him because, you know what I mean? So, but you may say, look, I accepted in good faith, I really didn't know that this is not the right number, and they may let that by. And usually what I say to the auditors is, well, understanding that we did things incorrectly this time, and I'm going to advise my staff to look at the number, but can we let this go for this time and then next time? And I would say, no, I tend to say, okay, I understand. But the typos are never an issue.
We have another question here. The question is, if you're doing business with a company that resales their purchases and sells to various ship-tos in different states, what's the best way to handle this situation?
So in regards to certificates, or I don't understand the question.
They've given an example here. It says, for example, we're doing a business with a company in Texas. They've been providing us with their resale certificate for Texas, and they decide to resell their purchases to various locations such as New York or Ohio.
I think what you're saying is like a drop shipment scenario. When you say by they, I'm assuming the person that is asking the question. So it seems like a drop shipment scenario, but every state has different rules in regards to drop shipments, so I couldn't really give you an answer. I'm not exactly sure how Texas or Ohio would handle drop shipments, but in some cases you would be able to present the Texas resale certificate, but in some cases that's not sufficient.
All right. We have another question here. What is the easiest way to validate sales and use tax numbers provided by customers in states that do not have online verification?
That's a good one. You can call a state for sure. That would be the next one.
Okay. And then we also have a question here. When we send exemption certificates to a customer, sometimes they send us a license certificate or seller's permit. Is that okay?
No, absolutely not. So seller's permit is just telling you that they're registered in the state. That's not telling you much. So yeah, I've gotten a lot of those where I'll get sometimes I'll get a W-9, sometimes I get an IRS form, sometimes I'll get, so no, it has to be an exemption certificate form.
Okay. And I believe you answered this before, but I just want to confirm. Someone's asking if there's a website or source that you can provide in order to validate an ID number.
The state's website, but there are states that don't have it on the website, so then you would have to call them to validate it. But in lieu of that, this is where you can actually ask them for a copy of their sales tax license.
All right, great. It looks like that's all the questions that we have on our end. So with that, I'm going to shut the webinar down. I'd like to thank everyone for taking the time to join us today, and I'd like to thank those at EisnerAmper and our presenter as well. I'd just like to let everyone know that if they could take the 30 seconds to fill out the survey as they leave the webinar, it gives us a lot of great information on how we can continue to make these better. So thank you again, and I hope you have a great rest of your day.
Thanks
everybody.